You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts, Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
And welcome back to the Option Block, your home for all the awesome options education and options knowledge and the who's who of options trading every day, all day, the awesomest podcast on the planet. I'm not Mark Longo. I'm Mark Sebastian doing his deepest voice possible. And it still doesn't sound nearly as deep as it possibly could. I kind of sound a little like Zoolander there with in the how can they learn to read if they can't fit in the building? But yeah, Mark is getting off a plane right now, so I am filling in. This is Mark Sebastian, founder of OptionPit.com, and with me on my co-host, the large to my small, the tall to my short, the strong to my weak, is former Buffalo Bill and head of RCM Wealth Management Barrington office. Not Barrington, excuse me. Where are you, Mike?
Lovely, scenic St. Charles,
Thank
Illinois.
You. The RCM St. Charles office, Mike Tosaw.
How's it going today, Seabass? It's good to have just the two of us. We'll get this thing done today, right?
Yeah, it's a great day, and it is good for just two of us. And yeah, it's good to be here. I haven't been on a while, and so it's nice to get a little alone time with my boy Mike Tosaw. So, how was your Thanksgiving, Mike?
Pretty good. I mean, I had to pull the turkey out of the oven for my wife, but spilled some turkey grease on my foot and got a couple second-degree burns. But aside from that, not too bad.
Now, you think that's bad? You should see the turkey.
That's right. I took care of that turkey, by gosh.
All right. Yeah, that's great. Mine was great as well. We do a pre-holiday turkey party at my house. We had 87 people in my house. I cooked about 70 pounds of turkey. Had 50 adults, 35 kids. It was a madhouse. But all is well that ends well. We had a great Bears win over the Packers, and so it was a great Thanksgiving for me. And while I could talk Thanksgiving and turkey destruction all day, let's move away from that and into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
And welcome to the trading block. Let's talk about what happened in the markets today. Well, SPOOs closed on their lows. The SPX closed on its lows, closing 20.8041. But VIX cash was only up about 1.05, which was nowhere near its highs, and the VIX futures, the Ds, Feb, Jan, all lower on the day. The weakest of the performers was in fact the S&P, followed by the Dow, which was down about 78, the Nasdaq, which was down $10. The Russell, only down about 3, was actually up for most of the day and then softened in the day, and that's really what led to the sell-off. Other movers and shakers, you had a little softness in gold, a little rally in oil, and a little strength in the dollar. Mike, what were you watching today in your trading?
Well, of course, the S&P. I think that I remember going to a restaurant once and seeing a sign, or just kind of one of those novelty signs saying, on this date, or I'm sorry, like on October 16th, back in 1874, at this exact site, nothing happened. And that's kind of like what it feels right now in the marketplace. I think everyone's just kind of sitting on the sidelines and waiting to actually see what the Fed is going to do in a couple of weeks. A lot of people are saying that they believe that they're going to raise. But the reality is that the Fed seems to want to hold us hostage, and we're going to continue to wait on that. And I really don't see much of a breakout in this market happening until such a thing happens. And then in regard to today's market, we had a little bit of a boost in energy. That was one to where some of the energy stocks out there that had a decent day, I could say. Chevron, for example, up 95 cents, up 1% on the day. XLE, the energy ETF, it's up 25 cents. So a bright spot in the S&P was the energy area, the energy stocks anyway. But other than that, it was a down day, but we're down less than 0.5%, and with the S&P being the lowest of the major indexes and still being less than 0.5%, after a week last week to where not that much happened, which is normal, and when we had some news come out on, I believe it was Tuesday, had a little bit of a scare early in the mornings, and then other than that, I'm kind of like, I need your partner Andrew to come out here and just basically tell the market to do stuff.
Yeah, well, the problem is the Fed is holding things hostage, and they've been so feckless and kind of weak that it's been frustrating. I liken the Federal Reserve to the story of the Grinch. The Fed thinks so much is about them and what they do. They actually think that they can control the markets, much like the Grinch thinks it can steal Christmas. Well, you know what? It doesn't really matter what their rate policy is and what they do, much like the Grinch stealing all the who hash and the who roast beef. It really doesn't matter. And the sooner they figure out that really all the market wants them to do is tell us what they're doing, and this pussyfooting, spineless weakness is really the major cause of the problem, sooner the markets will move on and move up. So I would say that while the Grinch had his heart grow 3 sizes bigger, maybe the Fed needs to have its spine grow 3 sizes bigger. So,
well, I still wouldn't touch him with a 37.5-foot pole myself.
Oh, interesting. So, I think thing 1 and thing 2 are sitting on the board right now as I look at it. Now, I would agree with you, Mike. The interesting piece was the VIX up pretty nicely and the VIX futures down. I'm not sure that's going to last. I think that we are going to see the SPOOs kind of churn, somewhere in the 2065, 2070 range up to maybe 2090, 2100 range. Kind of treading water. I think you'll see the VIX slowly creep to 17, 17.5, and you'll see the December futures maybe move up to 17.25, 17.5 as well. In kind of anticipation for non-farm payrolls. I do think these non-farm payrolls are maybe the most market consequential in the last couple of years, and that's really kind of sad. That's the Fed's fault, but that is the bed that they've made, and we all have to sleep in it for now.
Well, it is, because they keep saying how they're data dependent, so to speak. And then...
Yeah, well, stop being data dependent and start saying, here's where we think the data is going to go, and do something.
Yeah, believe me, I would totally agree on that. Now with that, just can you bring up a daily VIX chart for me, Mark?
I'm pulling up a daily VIX chart right now.
Okay, so a question on this, and maybe you can kind of explain, you being the VIX expert with which you are, maybe explain just some of the movement to the audience a little bit today. Later in the day, notice how, and I'm looking at VIX cash right now, not necessarily the VIX futures, but VIX cash. Notice how we have somewhat of a double top to where we peak around just before 11 o'clock Central Time, and then we have another top probably around a half hour before the close of cash trading. How would you explain as to why we were coming down a little bit to when in the S&P we were kind of going sideways in the S&P during that time?
Well, I think that you saw a couple of things. One, obviously, the 11 o'clock close was European markets, and that you typically do get a little, especially if Europe's down, you'll get a little pop in VIX, and just kind of the way things will happen. And then toward the end of the day, we did see the market sell off, and then I guess kind of people decided that a 9-handle sell-off is not worthy of a 16.5 VIX. And they said, we do want the VIX to stay high, but we think 16 ahead of this Federal Reserve meeting is about right. And they also anticipated maybe a little bit of VIX movement into tomorrow. Kind of need to see where things go tomorrow before you really allow VIX to sell off or VIX to rally this much. 16.5, you're not talking about, 1.1% daily move priced into the S&P, and it just was not there, and that would be why we saw that.
Okay, very interesting. I know it's always good to hear the point of view from someone who watches the VIX like you do.
Well, thank you. And yeah, it was a little confusing. Usually, when you see that kind of price action, it points toward we'll probably be green on the open tomorrow. Would be my bet. With the VIX somewhat unchanged, I think you're going to see the VIX stay between 16 and 17 for the next day or two, and then one of two things. We'll either see the pre-non-farm VIX dumpage, but this one's lining up to maybe a pre-non-farm VIX bid. It just kind of lines up that way because of the fact that it really is going to drive. It really is going to drive where what the Federal Reserve does. If we get a big revision downward, and the Fed doesn't say, we're still going to raise rates, markets could really be kind of nutty. So that's kind of my interpretation. So with that, let's roll out of the trading block and into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
And welcome to the Odd Block. If this is your first time listening, this is where I'm going to walk through some odd trades that trade today. If this is your nth time listening, you're going to hear much of the same. So this is QUNR, all right? QUNR, all right? Shares of Qunar Cayman Islands Ltd. I have no idea where that name comes from. It was up about $1 at the time of this writing, trading around $44. Paper bought a little under 1,000 of the January 60 calls. So this is a stock that's way out of the money, and we have a call buyer way out of the money. Average daily volume is about 1,800, so about half of that, and the open is just about 300. So the volume went up in one block on the ARCA, and then 6,000 contracts total traded, with paper mostly buying these calls. So traded in one block, but then there was a lot of buying. These things got bid up pretty quickly. At the time of the write-up, they were already trading $1.25. So this is some serious implied volatility, trading about 75%, and a 10-day actual vol movement in the underlying about 90%. So this is a mover and a shaker. So I was a little surprised by this one. So this is a company that offers travel products. Maybe with all the industry consolidation, they're a play to get scooped up by Expedia or Priceline or something like that. So,
well, you like to think that. The only other alternative would be if someone is hedging a short, of course, which we've talked about a lot on this show before, by buying calls, by hedging the short stock. But other than that, that's one to where you are absolutely right. That one is not just out of the money. That one's real. That one's not OTM. That's ROTM. Really out of the money.
And if you were going to hedge a short position, you probably would move in a little closer than 30% higher. That's typically me. All right, well, let's move. Look, the next one I'm looking at is ASNA, Ascena Retail Group. It was down 57 cents, trading about 11.30.
it is at the bottom of its 52-week range. So this is a stock that's had all sorts of problems. Paper traded about 20,000 of the ASNA Jan 2016-11 puts for about 70 cents. And they traded the Jan 2016-14 calls at 20 cents, and then they sold the D's 12 puts at 75. So it's all told 40,000 contracts. Kind of a weird trade, volume up in 3 blocks, but they're all a part of one piece. What this looks like to me is a collar trade with a selling the put, maybe take delivery, and trying to collect a little bit on it if the underlying does in fact rally above that $12 strike in December. So this looked like somebody who was kind of setting up a kind of bull backspready type of trade with a collar on it. So probably a hedge, but a really, really weird one. The part that probably throws most people off of the D's 12 puts, again, my guess is he sold those to take delivery. So he's trying to collect a little premium, and then he's going to take delivery on the stock, with the stock trading, 11:30, 11:35 on the day. I don't know if you this is not one I pay a lot of attention to, but it's got an implied vol of 66% and it's been trading about 55% over the last 10 days. So another mover, another shaker, but this time some serious volume.
Yeah, we're definitely going into the high vol end of the stock spectrum today, that's for sure.
All right, yeah, no kidding. Now finally you've got ZITS, ZTS, an unfortunate stock symbol, but it's short for Zoetis Incorporated, which is trading a little under $47. Zoetis is right in the middle of where it's been trading the last year. Paper bought about just under 84,000 of the Zoetis Jan 2017 puts for Jan 2017 35 puts for $1.25. Average day volume is 3,500 contracts, and so this was all opening, all 84,000 contracts. So this is one block tied up to stock. My guess is, if with being at the 35 strike, this is probably somebody that already had a big position that is setting up a serious hedge and says, I'm not willing to let my underlying drop below $33, but I still think there's a lot of upside. So they're just setting up a year-long hedge. Zoetis is in the engagement of discovery, development, manufacture, commercialization of animal health medicine and vaccines for both livestock and companion animals. So maybe they're worried about this environmental meeting coming up in as much as climatologists and climate people hate oil, about the only thing they hate near as much as oil is the breeding of cattle. And that's because cow flatulence is a serious contributor to greenhouse gases. A lot of people don't know that, but every time you bite a hamburger, you're allowing one more cow to release his flatulence to the earth.
Now, I have to say that is a piece of knowledge I was not aware of until this show today. I am a smarter man because I'm hosting the show with Mark today.
It is. A lot of people don't know that, but cow flatulence is a huge piece of the greenhouse gas effect. So there you have it, folks. There's all the odd trades I was seeing. And with that, we're going to roll out of the odd block and into the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
And welcome to the Strategy Block. And here's where I'm going to shut my mouth. I'm probably going to mute my mic, answer an email, and Mike is going to talk shop on how he helps his clients on a daily basis. Mike Tosaw, take it away.
I will take it away. All right. Over the last few weeks, I've just been kind of going over what I'm doing with my SPY positioning in terms of rolling calls up, rolling calls down, just trying to sell some premium and what's been pretty kind of a sideways market over the last few weeks. But just to give you an update on what I'm doing right there, really not that much. Just trying to get the time decay, continuing to just hold on to the calls and with the time decay. But a strategy with which I am looking at for the coming year in terms of getting into some stocks at a possible lower level is a ratio put spread. Now, to set the table for this strategy, I want to go over the good old-fashioned wheel trade, as Mark Sebastian affectionately calls it. Let's say that you like a stock, you sell a put below where the price of the stock is, and you let the stock get put to you. If the stock goes down, if the stock stays the same or goes up, then you can either let the put expire worthless or get out of it when it goes down to a nickel or a dime or something along those lines and start the process again. If the stock does get put to you, if the stock goes in the money and gets put to you, you let it get put to you, then you can work on selling covered calls on it. The Wheel of Fortune, Wheel of Fun, whatever you want to call it, that's the way with which you can do it. Now, let's say that you like that idea, and there's some stocks with which you want to get into, but you think the stock's going to go down to a certain level. Now, right now, this is one that I still think it's too high at this point, but when it does go, if it does go a little bit lower, this is a stock with which I'd actually consider doing this on. Once it got down to maybe the 110, 105 level, and you guessed it, it is Apple. I'm not ready to get into Apple again as of yet. The reason is that I think that Apple is a stock that made so much headway and did so many things because they changed the world. And until they have another world-changing product again, that's when I see a lot of movement in Apple. But in the meantime, they're still a phenomenal company, folks, and they still make a ton of money. But I think that they're closer to the top end than they are the bottom end at this stage in the game. So let's say that you disagree with me and you think that maybe getting into Apple at 110 might be a good idea for you. Well, one thing that you could do, let's take a look at January right now. 46 days between now and January expiration. The January 110 puts are trading at $1.12 by $1.15, so let's say that you get filled at $1.13 on it. Not a bad deal by any means, considering how far out of the money it is. And if Apple is to go down to the 110 level, then if you like Apple at 118, then you should love it at 110. But I personally don't love it at either of those prices. But let's say that I did. One thing that I could do, and as a way to kind of take the wheel trade to another level, would be a ratio put spread. Now, let's say that I'm looking to get into 100 shares of Apple, and I think it's going to go down to 110. One thing that I could do is I could just put a limit order to buy Apple at 110. Or if I wanted to have my cake and eat it too, potentially, I could do a 1-by-2 ratio put spread. Now, let's say that I were to buy one January 2016 115 put. Right now it's trading at 226 by 232, so let's just say that I buy it for $2.30. And I'm going to sell two, not one, but two 110 puts. Same expiration. And I'm going to sell them for, I'll say, $1.13 each. So by doing the math on that, I just took on a debit of $2.30 for the 115 puts that I bought, and I took on a credit of $2.26 for the 110 puts with which I sold. This is altogether a 4-penny debit. So let's go through the what-if scenarios on Apple. And in reality, you could put this out as a limit order for even money. With the intraday movement of Apple, I think it would be a good chance that you would get filled on this if you did it, if you don't want to take on a ratio spread for a debit. But either way, it's close enough for me to make my point. Now, let's say that Apple stays above the 115 mark between now and January expiration. Well, if that's the case, then all the options will expire worthless, and you will be out commissions, or 4 pennies if you wanted to buy into this spread for a debit, whatever the case may be. Let's say that Apple were to go from from where it is now to somewhere between 115 and 110. You're in the profit zone. You're profiting anywhere from 115 to 110 because of the fact that the 110 puts would expire worthless, and the 115 put that you paid a debit of 4 pennies for, or even money, depending on where you got filled, would be profitable from that point. Now, of course, it's not going to be that exact of a science. As most of our listeners know, you're going to get out of it most likely before expiration. But my point is that you actually have some type of protection not only protection to the downside, you have something potentially profitable to the downside. Now, let's say that Apple goes to 110 and it goes below 110 and you get yourself assigned. Well, if you like Apple at 118, then if there's no fundamental change in the stock, then you should, in theory, love it at the 110 level. Now, not only that, not only will you own 100 shares of Apple, but you will get $5 in profit, assuming you got even money on the trade, between 115 and 110. How do you do that, you might ask? Well, let's look at this trade step by step. The 115 put is where your profit would be coming from. And the one of the two 110 puts is where your limit would be on that profit on the 115 put. And the difference between those strikes is $5. That's where I got the $5. Now, the other 110 put is hedged by nothing but your cash. So that is where you would have to take on owning the stock at the 110 level, which you want to do anyway. So let's think about this trade for a second. Let's say that you want to get into a stock, but you feel it's a little bit high in value right now, and you think it's going to come down, and you think once it does go down, it's a good point to buy the stock. Well, if that's the case, then doing this 1-by-2 ratio put spread might not be a bad idea as a way to get into the stock. Once you're actually in the stock, then you can start selling covered calls or maybe do a ratio call spread to combine with it to get some extra leverage on the way up if you think it's going to go right back up. I don't know. It's whatever works the best for you. But my point is that this is a strategy with which to consider. Now, once again, I'm not doing this with Apple right now. In my opinion, I think it's still too high to do so on. But if Apple does get a little bit of a pullback going into the new year, this is going to be a strategy that I will look to employ some money with on Apple as a way of starting up the wheel trade. Now, if Apple starts to invent another life-changing product like they have in years past, then I'll jump on the Apple bandwagon again. For those of you that listen to the show, know that I'm not shy about doing such a thing, but we need to get some type of life-changing product on the stock before we do that. So, with that being said, I'm going to turn it over to my good friend and co-host, Mr. Mark Sebastian.
Well, thanks. Yeah, everybody that thought that Apple Watch was going to be life-changing has been proven, unfortunately, unlife-changed so far. But who knows? Things could change. And with that amazing strategy block, we're going to roll out of that and into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
Welcome to Around the Block. This is where Mike and I are going to talk about what we think's going on. Mike, what do you see happening in the next couple of weeks? Or the next couple of days?
Non-farm and Fed. I think those are the two big things. I think you're probably going to say the same thing, quite honestly. I think those are going to be some of the big market movers. I'd like to see us get some type of movement in the market beforehand, but I don't see it happening, quite honestly. But those are the main things with which I'm watching. And then the other indicator on whether it's going to be a bear market or not is to see if the Chicago Bears can get to 500 or not this coming week.
I know. I'd love to see that. Yeah, it's all Fed. It's all, what's going to happen with rates and non-farms. It's going to be a slow, boring week. And unfortunately, that is the bed that's been laid for us. And that's where we're going. So with that, let's see what's going on with people. Mike, what's happening, bud?
A couple things, just like I've said on the show before. My book is going to be the second edition of Go Long, New Option Strategies for Buy and Hold Investors. Is going to be released on Kindle on the first of the year. Along with that, if anyone is interested in having a financial advisor in some way, shape, or form, make sure you do so now before the holidays come and you forget about that stuff and you're drinking too much eggnog and you get run over by a reindeer or something like that.
Yep. My portfolio got ran over by a reindeer. Or hopefully the Grinch doesn't steal your Christmas. Think about it that way. Here at Option Pit, this Saturday we're doing another one of our 4-hour classes using options to trade for directions. Go to www.optionpit/DIR primer. Use code 25_off, OFF, all caps, to take $25 off. And with that, we'll let everybody go. Enjoy this abbreviated show, and we'll see you next time on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.